Hi YouTube, please give me a moment as I go live on Facebook. Live on Facebook. Hi everybody, good afternoon, hope you're doing well. This is Sami Abu Saad with the Strategic Day Trader with another weekly lesson for you. We just finished, it was kind of a short coaching session today for SDT members, Strategic Day Trader room members. And right now the lesson portion of it, which is what I share with you. Before we start, as always, a standard required disclaimer to let you know that trading is risky and that whatever we discuss is for educational purposes only. Also, I want to say if you find benefit in today's video, I'd really appreciate it if you hit the like button, and feel free to check out the links in the description of this video below. Okay, with that said, we'll go ahead and get started. Currently we are talking about the variations on the T3 live pullback play. Okay, we covered part 1 last week, so today we're going to cover the rest of them, and today is going to be part 2. I don't think there's going to be a part 3 to this, but there might be. We'll see how much progress we make today. So as I said, as I always say, stocks can correct through only 2 ways: by going sideways after a rally up, in which case you can play the base breakout. Oops, I'm off the so here it is, in which case you can play the base breakout, or they can correct, which is more common, by pulling back. So right now we're studying the pullback, and we're saying that most pullbacks, this is the T3 live buy setup. What I'm saying is most of the time it's not this simple. Just a rally, 3 or more red bars in a row, and then a trigger. It's not this simple. And we talked about the amplifiers in not the last lesson, but the lesson before that, and the one before it. We talked about the things that make the buy setup better. But as I said, the vanilla play, the standard buy setup, if it's a picture perfect buy setup, you don't need to do anything. You can just buy it above the last bar's high, stop under it, and target the prior high, and that's it. You don't need to do anything extra. Standard play means standard entries is fine. But a lot of times you don't get a picture perfect buy setup like this one, or like the one before it. You don't get a vanilla play, right? You get more more challenging setups. You get setups that look like this. This is a 15-minute chart, and on the 5-minute was in an uptrend, didn't even look good. So how do you play these? How do you take advantage of these? Is there a way to do it? We covered, as I said last week, we covered the first, I think, 4 patterns. I'm going to show you a total of 8. So the vanilla pattern is the first one. The thing about it, the thing to remember about this is you need to have multiple time frame alignment. So in the afternoon, I trade primarily the 15-minute chart. If you trade the 15-minute chart, you want to make sure that the smaller time frames, the 5 and the 2, but mostly the 5, usually just the 5, is also in alignment with the 15. Okay? So if the 5-minute, this is the 2-minute, but if the 2 or the 5 were in an uptrend, so you have to make sure that the uptrend fails first before you can get in it short on this sell setup. Got it? And we said in this case, this is when it failed. So here's the uptrend, pullback, buy setup, failed to make a new high, and then here's the higher low, and it broke under it. So the moment it broke under the pivot, that would have given you your entry short. Stop right here. Okay? And then target the prior low. But in this case, we ran out of time. I ran out of time. It didn't get to the lows because I ran out of time. So that's the first vanilla pattern. The second pattern is my favorite, and it's called the bleed pattern, where the stock pulls back, but if the pullback is deep, like this one was, you want only the stock to correct only 40 to 60%, so maximum of, let's say, here. Instead it pulled all the way down to there. If the pullback is deep, all these people that bought it on the way up are now underwater. Usually what happens is when it gets bought, when it pops, it comes right back down because people get out of it, start to offload, right, their shares. But what if it doesn't fail? What if it pops and goes sideways? How about then? Then that would be the ultimate show of strength. If the stock pops and bases at the top, then you can play it as a breakout, even though initially this was looked at as a buy setup. Notice how it was played as a breakout, and then another breakout, and then a buy setup. Huge play. You can find this setup on every time frame. As I said, I scan for these in the afternoon on the 15-minute chart. This was actually a 5-minute time frame. It wasn't the 15, it was the 5. But most of the time I play them off the 15-minute chart. Notice here, the stock rallied hard, was not at the 20. If it's not at the 20 MA, then I usually wait, because if you don't wait, again, it goes up, comes in, and then fails, and you get stopped out. So you don't want to take the first entry. You let it go, and if it goes sideways into the 20, then you can play the breakdown. So this is a play on a play, or a play inside of a play, a breakdown inside of a larger sell setup. And this is what I call the bleed. The stock bleeds sideways into either a declining 20 or a rising 20 if it's in an uptrend. That's my favorite intraday pattern of all time. Okay? While this is my favorite intraday pattern of all time, this is my favorite location, the gap fill. The gap fill refers to the area when a stock gaps and then comes back down to fill the gap. It's an area of great support because anybody that shorted the night before or the day before gets the chance to exit at break even when the stock fills the gap. Does that make sense? So that's my favorite location, my favorite spot to play long. If the stock, if I can get the stock to drop there. Sometimes though, you want to be careful because sometimes it opens here and starts to downtrend slowly but surely, like so, lower highs, lower lows. Then you don't want to just play a downtrend long. We saw eBay do that yesterday. We're talking about a stock that gaps up over here, let's say, and then sells off hard into the gap fill, almost like a flurry down into the gap fill, not lower highs and lower lows. Okay, that's why I say here, while the stock is pulling back, the smaller time frames will likely be in downtrends. If any of the time frames is putting in lower highs and lower lows, it's really important to not buy the downtrend unless it breaks, or unless it produces a wide range bar on volume, meaning unless it goes a little bit climactic. But that's actually my favorite location to buy. So here's an example. Stock gaps up and then falls hard, and then notice the climactic sell-off into the gap fill. In this case, into 1030 reversal time, also into the flat 200 on the 5, into the rising 20 and the flat 200 on the 15. Perfect. What else do you want? This one I got out of, unfortunately, got out of it too soon right here. It continued higher, but I messed it up on the way out. So not only do you have to nail the entry, but you also have to get out at the right place. Otherwise, you end up messing up the trade, or you could end up losing. Notice again here, the stock gap to resistance on the daily chart, the 200 MA, that's the red line, the prior pivots, 2 of them, gapped into resistance. When I was fairly new to trading and I started to trade gaps, that was 14 years ago, I used to discard these gaps because I would say, well, this stock is already gapping to resistance, is already gapping to target. When you're playing something long, resistance is your target. So if a stock gaps to resistance, it means it's gapping to target. So I used to actually not even put these on charts. I used to just completely disregard them. Later on, I realized that you can always play a stock that gaps to resistance as long as you don't play it early in the morning on a breakout. You have to wait for it to pull back away from that resistance, and now you can play it long above the last bar's high with a target at the prior pivot high. Does that make sense? So notice the gap fill also at 11:15 reversal time, at the rising 20 also, and the minor support, which is the gap fill. Plus it had a COG bar. So this had multiple amplifiers, at least four. Okay, that's the gap fill. Sometimes stocks that are really strong don't make it all the way down to the gap fill. They don't fill the gap. That's fine. Let the moving average be your guide. As long as it pulls back at or near the moving average, this was near the moving average, then it's okay. It doesn't have to actually fill the gap. We just want them to fill the gap when the moving average is still there. Like here, see this? The moving average was there. So let the moving average be your guide, and that's why I just really couldn't trade without the 20 MA moving average, the blue line, because I use it in so many different ways in almost every single trade that I take. You can also do this gap fill pattern at the open or shortly after the open. Stock gap down under base and rallied up at the open into resistance, into the gap fill, short. Notice also the breakout failure. Talked about this last time. That's a breakout failure. So just under it, short. And look at the huge fall after that. Huge fall. Volume surge, indicative that the worst is over. The sell-off is probably over. More downside could still come, but for now that was probably the bottom. Notice you might say, well, why was this not the bottom? Because there was not much at least, volume spike. Surge. Minor, but it wasn't bigger than this. It wasn't bigger than these two bars or the one at the open. So if a stock is downtrending and it doesn't put in wide range bars or a spike in volume, then it's likely not over yet. But in this case, put in the spike in volume, and that was it for the morning at least. So we talked about all of these last week. Then today we're going to talk about other variations that you can look for, that you can scan for and trade when you are when you're looking for that buy setup pullback pattern. One of the most famous, most well-known patterns of all time in classical technical analysis is called the W pattern. The problem with the W pattern is most people don't know what it really means. Like most people think it's a double bottom. So if we get a stock selling off and double bottoms, you should play it long. You should never play a stock that's downtrending long. Got it? So if the stock is downtrending, let me just put this on top here so I can draw over it. If the stock is downtrending, if the stock is downtrending and in double bottoms, I would never ever play it long, because the definition of a downtrend is lower highs and lower lows. It's supposed to fail. Double bottoms in downtrends are supposed to fail. You only want to look for the W pattern if the stock was already in an uptrend and pulled back, and the double bottom happened to form in the context of an already well-established uptrend. See, that's the uptrend. Stock was actually uptrending and pulled back and then gave us the W pattern. Does that make sense? So you don't want to go around scanning for stocks that are maybe perhaps in a downtrend and double bottomed. That would be the wrong thing to do, because most of the time they just continue lower. Downtrends by definition continue lower. So if you're gonna do the W pattern, it has to be inside of a larger uptrend, and then you're just getting a W pattern or a double bottom that creates a W pattern. Now the W pattern is a failure pattern. Why is it called a failure pattern? Failure patterns are the strongest patterns, is how the market speaks loudest. We say the market speaks loudest in its failures or in failure patterns. The W pattern is one of those failure patterns. How is it a failure pattern? Does anybody know? Does anybody know how the W pattern is actually a failure pattern? Anyone? Okay, no problem. It's a failure pattern because it's a failure on the smaller time frame. So if the stock is uptrending, pulls back, right, and rallies, gives you another pullback to continue lower, so it's in a downtrend here basically, moves up, attempts to continue. Oops, I'm sorry, I'm drawing outside of the region that I'm projecting. So let me start over. If the stock was downtrending, like so, and rallies, comes back down, people are expecting that downtrend to continue. If it all of a sudden double bottoms, it means it failed on that downtrend. Again, you don't want to be playing it, you don't want to look for a W pattern unless it's inside of a larger uptrend. Inside of a larger uptrend. If it is, then sure, you can look to play it long. Like in this case, the stock was inside of an uptrend, and the smaller time frame downtrended and then gave you the double bottom, which is the W pattern. Okay? So let's take a look at real charts here. Real charts. Now the W pattern has different also forms, different types. There's the W pattern with a double bottom, right? So you get the rally, the sell-off, the attempt to go higher, and then the retest and failure, the failure to continue lower, I mean. That's a W pattern with a double bottom. The entry for a W pattern is over the last bar's high and or over the neckline. Over that doji bar's high right here is always aggressive. So I would only want to do it over here if I was sure about the play and or if playing it over the neckline is not feasible, meaning maybe the stop becomes too big, right? Or the target becomes too small. So if that's the case, then I would consider playing it over the doji bar, over the last bar's high, and not over the neckline. But again, just want to be sure I communicate this clearly to you. On a W pattern, when the stock is coming in, so here's the W pattern. That's a W pattern. The entry, there are two entries. The standard entry is over the neckline, right here. The neckline break. The problem is, a lot of times, entering here and putting the stop here makes for a really large stop. Really big stop. So the alternate entry would be over that bar's high. And if the stop is big, then just over that bar's high. If the neckline is not too deep, then you can play half here, half there. Or sometimes we get W patterns that are very small at the bottom. Then I would just play I would enter right here and put the stop under the double bottom. Got it? And not worry about entering above the last bar's high. So that's the W pattern with a double bottom. W pattern with a double bottom. Anytime you have a deep pullback or a pullback that breaks the 20, I'd want to pass on the first entry and look to do it on the second entry, the secondary sign of strength. Okay? In this case, it came in the form of a double bottom or a W pattern. Sometimes it comes in the form of a bleed. It comes in the form of something else. So whatever it is, you just have to wait for that secondary entry. Notice the daily was gapped up over after being down a lot. So gapped up right here over the last two red bars, but perhaps gapped to resistance because it sold off after the open and right to the flat to 20 MA. When it's flat, it's not powerful. I want to show you here. When the 20 MA is flat, don't play a long off of it if the 20 MA is flat because it's not powerful. But when you get a double bottom or a W pattern off of now a curling rising 20, then you can play it. And notice the narrow range bars. Narrow range bars are indicative of a turn coming. Okay? indicative that there's going to be a reversal. So W pattern off of the curling rising 20 MA at 11:15 reversal time or so. Beautiful, with a gorgeous professional gap up. And notice the big pop. Beautiful. Okay. Now sometimes we don't get a double bottom, we get a higher low. A higher low is nice because it is giving us more information than a double bottom. The higher low is saying the buyers are not even waiting for the stock to double bottom. They're stepping in early and buying it. So that's a sign of strength. So again, uptrend, the first buy setup was extended away from the 20. I usually pass on these. The secondary entry was right off the 20. Notice this was gapping up. So entry was over the red bar and or over the neckline. But over the neckline would have made it not feasible because it was a big stop. Would have been a big stop. Okay. The pullback was pretty deep and away from the 20. Pass. Second buy setup. Notice all these narrow range bars. Pretty good. Entry was, to tell you the truth, the entry was here. But did I think it was ready there? Did I think it was really ready after two big red bars? No. Once it based a little bit more, right off the 20, entry here, stop right here. Beautiful. Same entry as earlier in the day, right here. Same price, I mean, but it wasn't good there. It was much better right here. And then big pop after that. Okay. Notice this. A gap, a breakdown on the daily chart. This is the daily chart. Breakdown to new lows, and the next day the stock gapped up. Beautiful. That's a breakdown failure. Trapping the shorts. The gap trapped the shorts. The problem is it gapped right to resistance, to the top of the base. That's a lot of resistance. So when it gapped up in the morning, it got sold hard. Again, in the past, I used to disregard these gaps because I would say it's gap to resistance. But on a pullback, you can always play it long again with the prior high becoming your target. In this case, though, it came in hard and notice the 20 was still pointing down. So it wasn't really that good. Here's the initial buy setup and here's the higher low. So that's what I call a W pattern with a higher low. Got it? With also, it was transitioning on the 15-minute chart. Beautiful. Sometimes it's an M pattern with a lower high. So you get the initial sell setup. If you're not sure about it and you don't like it, pass. Or if there's anything wrong with it, wasn't at the 20, pass. If you get a secondary entry, in this case it came in the form of a lower high or an M pattern with a lower high, then sure, play it. Short. Okay? So that's a short. Here is another short. The initial rally was pretty strong. Was okay, I think, to do, but was strong. And the better short was under the bars low. Or under the base. Under the base as a bleed pattern. So this was kind of a hybrid between an M pattern with a lower high and a bleed pattern into a base into the declining 20. Notice on the daily chart, shock gaps and failure patterns set up the unexpected, thus trapping traders. This tends to cause major problems for most ordinary traders, but they can serve as major money-making opportunities for us. In other words, we are always prepared to profit from a stock's failed attempt to do something highly expected by the majority. What was highly expected by the majority? Well, it was in an uptrend. So the expectation would have been to continue that uptrend. The moment the stock ends the uptrend, it usually comes in really, really hard. We saw that happen. I mean, every day we see it. We see this. But yesterday we had a gap that ended the long-term uptrend. It was a great short. Today MTSC ended the uptrend. I mean, that's amazing. See how it ended the uptrend? And what happened? Look at the sell-off. Because everybody starts to get out of it. But in this case, it's not just the long-term traders, it was also the short-term traders that bought it yesterday. A lot of people bought it expecting it to gap up, and today it actually gapped down. So this trapped a lot of people. We had another one just yesterday. I don't remember the symbol. Do you guys remember that the symbol of a stock that broke the long-term trend? I forget what stock it was, which stock it was. This is the MTSC today. But we had something yesterday that was beautiful, broke a long-term uptrend. AMBA? No. AMBA, no. AMBA continued the uptrend. Okay, great. Continuing, I don't remember what it was. We'll skip that question for now. And then pattern number 6 is the W with a shakeout, meaning the retest of the prior low actually works, meaning it breaks and it immediately snaps back. So that's what I call the W with a shakeout low, with a lower low rather than a higher low. Let me give you an example. In this case, it's a sell setup. You get a stock that's in a down, so it's an M pattern with a shakeout or a higher high. You get the sell setup. See the sell setup right here? Let me erase this. You see the sell setup right here? The red bar? Failed. If you took it, you would have gotten stopped out, because the entry for this would have been right here and stop right here. So, and the stock went above it, so it stopped out right here and stopped out. But as I said, if there's something wrong with the play, with the chart, don't do the first entry. Never. In this case, it was down too much already, so it wasn't quite ready to continue lower. At any rate, if you pass on the first entry, you got a sell setup that failed, but immediately that new high got rejected. So as soon as the uptrend fails, right here, short. Or right here, short. That's the 2 minute and that's the 5 minute. Short. I wouldn't have played it there as an M pattern under the last bar's low, because it would have meant playing it while it was still in an uptrend on the 5 and the 2. So I definitely would have waited for the neckline to break in this case. Okay? Would have waited for the neckline to break. This is a W pattern with a shakeout low, right? With basically a break below the prior pivot low, and the breakdown bar's high got taken out right away. When that happens, it's always a shakeout. So again, when the prior bar's low high, the bar that breaks the pivot, the high of that bar gets taken out by the very next bar, it's always a shakeout, and you just get in it. If you bought it here and you got stopped out, get right back in. If you didn't play it, which you shouldn't have because it was below the 20, then you can just play it right here. Okay? So that's what I call the W with a shakeout low. All right. Pattern number 7 is the mini climactic, that is, into a flat 200 MA. A multi-bar drop into a 200 MA on the 15-minute chart often stops the stock dead in its tracks. While the 20 MA is most powerful when it's trending, the 200 is most powerful when it's flat. Combine that with a mini climactic drop with volume surge at the end, and you get a strategy that can be traded almost independently of anything else. Meaning, you can actually play this strategy on the 15-minute chart without any regards to any time frames, without looking at any other time frames. What am I talking about? I'm talking about this. When you have a multi-bar drop, in this case almost 2 days worth of selling or a full day worth of selling, and it starts to print wide range bars with volume spike into a flat 200. Just buy it above the last bar's high. Just buy it. Trust me on this. I hate to say trust me on this, but in this case almost you can just buy it, like I said, without paying any attention to any other time frames. It works like crazy. Multi-bar move up into a flat 200 on the 15 and into a flat 200 on the 5. Beautiful. That's a short under the green bar's low and into the declining 22. Under the green bar's low, stop above, target. If it's just a pivot, you can target the low of the day. In this case, my target was right here or right there. It continued much lower, but I was already out. Okay, beautiful. This is what I call the mini into a flat 200, and that's pattern number 7. Okay, I know that's a lot of information. Feel free to review this later on, to listen to the recording one more time later on. Pattern number 8 is what I call Twin Peaks, because I live in the Bay Area and we have a famous tourist attraction called Twin Peaks in San Francisco actually. And what it is it's a double top. So you might think, oh, that's the M pattern. No, it's not, because it's a double top inside of a base. So you have a base and you have a double top. Got it? So take a look. You have a gap down in this case, a base, and a double top inside of the base. So short under the second top, or just under the entire base. If the base is tight, you can just short it under the base. So this is it. I call it Twin Peaks. You have a base, there it is, and a double top. Beautiful. The second top, the first top is just the pivot, but the second top is called the money bar or the shakeout bar. Got it? The shakeout bar. The stock tried to go higher and got slammed. That's when you know it's about ready to break down. So short under the base in this case, because it was the same as the topping tail bar's low. Beautiful. Look at the big drop. We're talking from $67 to 63, non-stop almost. Yeah, non-stop. Every bar was red. If you went bar by bar, you wouldn't have gotten trailed out, even bar by bar, which is the tightest management method. So you get a double top. I don't see the initial top really, but you get the base, and then it tried to go higher and failed. So there was like triple top here. There's top there, top there, top here. But look at the shakeout. Beautiful. And then short under the base. Isn't it beautiful? Love it. So these are variations on the 15-minute buy setup play that I take, that I scan for every single day. Every single day. Question. So when we get a spike in volume, that's telling us that the other side is stepping in, right? No, wrong, actually. I'm sorry to say. So you're asking about the first chart, that one of the first charts that we talked about, which is here. What does a volume spike after the stock being down a lot mean? What does that mean actually when we get a spike, a surge in volume like this? Does anybody know what that means? Anyone? Exhaustion, yes. Exhaustion of who? Exhaustion of who? The sellers. Correct. So that's why when you said the other side stepping in, I said no, that's wrong. It's not the other side stepping in, it's exhaustion of the sellers. And the lack of sellers makes the stock go up. It doesn't have to go up, but if there's no selling, guess what? It usually bounces back up, because any buying and the stock pops. Does that make sense? So it's right, exactly. Wash out of the sellers. That's exactly right. Wash out of the sellers. No, notice why it happened here, because it was the break of the low of the day. So the psychology behind this is the traders that were in it finally got the bounce, and finally they thought, okay, wow, that was it. Down, let's say, down 3,000, 4,000, 5,000, 6,000, 7,000, 8,000, and finally, okay, oh my God, now back down 6. Hopefully we continue higher. Instead, the stock comes back down and actually takes out the lows, and that's when they throw in the towel. That's when here is when they said, okay, the hell with it, I'm out. And that's why you get the spike in volume. We got the spike in volume. Okay, but unfortunately for them, this is the thing about trading, is you have to do what's right. I'm not saying that I play swing every single day. I have positions overnight. Sometimes you wake up and something happens and the stock goes against you. That doesn't mean you have to hold it for another $2-3, right? Does that make sense? You have to manage it. So if you get out late, what happens is if you don't exit at the right moment, at the right place, right time, then the more the stock drops, the bigger your loss, and the harder it becomes to take it. The harder because now it's a bigger loss, but also because you know that you messed up, and you're just really hoping that you don't have to pay for it. You're just really hoping that the market saves you somehow, that it goes back up. So it becomes much harder to take. So I always say discipline is doing the right thing at the right time all the time. That's discipline. Is doing the right thing at the right time all the time. And again, I'm not saying that I don't ever have a lapse in discipline or make the wrong judgment, or I do, but you have to get in the habit of doing the right thing at the right time all the time, as much as possible. You get in the habit, and it becomes what you do. People think, oh, this guy is really disciplined. No, it's just what you do. You kind of teach yourself, you create a routine for yourself, and it becomes part of your routine. It's part of what you do. Got it? So always get out as soon as you suspect that the play that you're in is no good. Get out. Okay? Don't let hope keep you in it. Hopium, as some people call it, right? In trading. Hope, unfortunately, makes us stay in losing trades far longer than we should. This is what also Jesse Livermore says. You know, they stay in losing trades far. How does he put it? Hope keeps you in losing trades longer than you should. Had you not listened to hope, right? The same ally that is so potent a success bringer to empire builders and pioneers, big and little. And fear keeps you from making as much money as you ought to. The successful trader has to reverse what you might call his natural instincts. Instead of hoping, he must fear. Instead of fearing, he must hope. That's a passage in Reminiscences of a Stock Operator, which is my favorite book of all time, on trading. Okay? So you don't want, when we're losing, usually we start to hope that the stock goes back up. But you want to kill it quickly, and you don't want to have hope. And when the stock is going in our favor, oftentimes, let's say you shorted this, we develop fear of giving back, and we end up getting out too soon. So he says you must reverse these natural instincts, hoping and fearing. Instead of hoping, you must fear. Instead of fearing, you must hope. Or, that's pretty hard. How do you reverse your natural instincts? I mean, I don't know of a way to do it. What I say is just develop awareness of it. Just become aware of it, of the issue, and then it just resolves itself by itself. For the most part, you wouldn't even have to do much about it if you become aware of it. But if you don't ever cultivate awareness of something, then you're never going to solve that problem. If you don't know the symptoms to a disease, if you're not aware that you have some disease, God forbid, you're not going to go to the doctor and seek treatment. Does that make sense? It's the same here. If you're not aware that you have this issue of hoping, every time the stock goes against you, start hoping, and every time it goes your way, you start fearing. If you're not even aware of this, then you're not gonna know you have a problem actually. All right. So trading is very much psychological. Now, yes, it's technical also, and you know what you need. I mean, you have to learn what you need to do. We talked about earlier, before I started the broadcast to social media, how you have to be flexible. Right now is not the time when you should come to the market with an aggressive mindset where you think, I'm gonna conquer the world today. No, you should be more laid back. Other times when the environment is really good, I said you could, that's when I'm usually aggressive. Right now, I showed you my P&L earlier, $1,500. That's pretty good. I'm happy about that. That's good. It's not a lot of money, but hey, right now is not the time to push it. So I'm satisfied with this. I let the plays come to me. If it was a much more active market environment, much more dynamic, I wouldn't be happy about this. I'd be more aggressive. I'd be looking for trades a lot more aggressively and entering trades a lot more aggressively. So right now, you have to develop that flexibility, and I said that's the hardest skill to really develop. At least for me, it was the hardest thing to learn, which is to be adaptable to the ever-changing market environments. But so you have to also do the same with many other things in trading. And if you know how to trade and you have the right psychology, then you're bound to succeed. You are bound to succeed. It just becomes a matter of time. But if you don't know how to trade, like you don't know what patterns to play, what kind of stocks to look for, right? And you don't have a good psychology, you're not aware of all these things that we just talked about and many other things that we're not going to even talk about right now, how can you succeed? It'd be impossible. It would really, I hate to use the word impossible, but almost impossible. At any rate, I hope you enjoyed today's short lesson. I guess it is not that short. And if you'd like to trade with me live for the next 30 days, feel free to check the link in the description below. You can actually day trade with me for the next 30 days for only $49. So you can try out the room, see how we do what we do every day in the room for the next 30 days for just $49, less than what it costs to have a decent meal for 2 people. Okay, that's the Strategic Day Trader, which is the room that I run along with Ifan and James. Now, if you say, well, no, I'm a swing trader, great, wonderful. You can actually join me in the Strategic Swing Trader newsletter, and you can get all my earnings plays. Today I had 100% batting average in the calls that I made, the earnings plays. And I think I called five or six earnings plays. Every single one of them was a winner. I did have one small loser, but that's because I played more than the ones that I called. There were some thin ones that I took on my own, like MOV short was too thin to call, and that ended up being a pretty big one. It gapped down 22%, I think. But the one that I lost on was the DY. Gapped up 5% or so, and I was in it short. So at any rate, if you'd like to swing trade with me, you can also try out the Strategic Swing Trader newsletter for just $49 for the first month, and then $95 per month after that. And it's month to month, no commitment. It's wonderful. I love it like this. You're not trapped into something that if it doesn't work out for you, you can cancel it anytime. That's the ideal way to do it. But either way, I hope you enjoyed today's lesson. And if you have any questions, reach out to customer service, info@t3live.com, or call them at 888-998-3548. Thank you so much, everybody, and have a wonderful evening. Take care.